Well, we just had a congressman freak out about the bank bailouts that are occurring. And then, of course, you've got people in the venture capital space who are coming to the defense of the bailouts. Let's listen first to this freak out from Representative Thomas Massey. Thomas Massey has been pretty involved in these in monitoring and commenting on these bank bailouts. You should listen to some of the comments he made because they might echo some of the sentiment that or at least what you're feeling. The last 5 days simplified, he says on Twitter, quote, a group of wealthy speculators got upset that their money ended up locked into a 10-year obligation at less than a 2% return. So they convinced the government that it was in everyone's best interest to help them out of their jam at the expense of everyone else. Oopsies. You know, what's actually very interesting about that is you've actually got people like the governor of California, who apparently had 3 to 4 of his personal or winery business accounts at Silicon Valley Bank. The governor of California was one of the beneficiaries of the easy lending of Silicon Valley Bank. And what's the governor of California doing last week when Silicon Valley Bank was having trouble? Pounding the table about talking to people at the highest level of the White House and the Treasury Department to help protect you. Yet he doesn't disclose that he actually banks there and he's really trying to save himself. So maybe Representative Thomas Massey is onto something. But it's not just that. See, Thomas Massey goes on to say, when the debt limit is increased, the Treasury is going to need over $500 billion to unwind these, quote, extraordinary measures that have been implemented for this banking crisis. Now, remember, folks, look, I'm a licensed financial advisor. I run an active ETF. I've got programs linked down below on building your wealth with an expiring coupon code. I've got a real estate startup. I do finance for a living. People are clamoring about this idea about whether this is a bailout or not. Let's be clear. Today, it is not technically a bailout. It is using money that already exists in a treasury fund. However, that fund was established using appropriations, congressional appropriations, which come from, guess what? Taxpayer money. That means taxpayers are guaranteeing this bailout. So yes, technically, taxpayers are bailing out Silicon Valley and wealthier, potentially, entrepreneurs or businesses who had more than $250,000 in their accounts and didn't, manage their cash in such a way where they were properly diversified. Remember, you could use the FDIC calculator by Googling FDIC calculator, and you'll be able to do that. Make sure you're at the .gov website. And you can see how easy it is to actually get up to $1.5 million of FDIC insurance just by having various different accounts, whether you're married or you've got retirement accounts, business accounts, whatever, sole prop, corporate accounts, whatever. It's actually really incredible how much FDIC insurance you could actually get if you just try. Now, the good news is everybody who escaped from this scot-free, I think, is now waking up to that, and they got a little wake-up call. Now would be a very smart time not to rely on the government. It would be a very smart time to diversify your bank accounts. But anyway, Tom Massey goes on to say that he expects we are going to have to come up with about $500 billion to unwind these, quote, extraordinary bailout measures. Because he says that what we're experiencing right now seems to be a shock to the current system, and that if money is, quote, printed like it was printed for COVID, then unfortunately it's going to cause more inflation. The reality is, had the government not bailed out Silicon Valley Bank, the reality is, he says, quote, depositors would have only lost about 20%. They wouldn't have needed all of their money right away. Now, that's an interesting point because a lot of people are going, we needed to do these bailouts because, small businesses weren't able to make payroll. Let's be real. If you had an 80%, if you had access to 80% of your money and you took a 20% haircut, you'd have enough money for payroll. But it would let capitalism do its job and prove that the government is not just an infinite bailout machine, and it's certainly not just a bailout machine of on average, wealthier Silicon Valley-based startups. Now, don't get me wrong. I don't want anybody to lose money. I'm just a capitalist at heart, and I think any venture capitalist should be thanking the government that we have right now for the bailout, because probably a 10 to 30% haircut would have been what would have happened. So you basically got a stimmy check from the government. That's basically what happened. And I'm happy for you. Don't get me wrong. I'm not resentful. I'm not upset. I think, though, any entrepreneur would agree that as a capitalist, it makes sense that a depositor should have some responsibility for determining where they put their money. Now, the counter argument there is, no, that's the regulator's responsibility. And when the hell does any capitalist say the regulators are supposed to protect me? Really? If your business fails, was it the regulator's fault? If you made a bad decision and you lost a big customer or client, was it the regulator's fault? If you crash your car, was it the DMV's fault? If you, drink and drive because you bought alcohol at a liquor store and then you go drive and crash your car, was it the liquor store's fault? Was it the regulator's alcohol board fault? No, it was your fault. So that's just the reality of a capitalistic environment. And so I think Thomas Massey is really echoing that sentiment here. And he actually goes as far as saying, look, half of venture capital-backed companies fail. So, it's not like businesses don't go out of business. That's a normal course of business, as businesses go out of business. But also, somehow venture capital firms manage to achieve greater than 10% annual returns, or at least that's common, says Thomas Massey. And so the notion that several of these companies at Silicon Valley Bank taking a 10% haircut would have caused an apocalyptic disruption of innovation is straight up bullshit, he says. This is Thomas Massey, representative. I actually think he makes a really good point. Somebody ended up replying to Thomas Massey and says, we bailed out a bunch of professional speculators. And he replies to that and says, precisely. Now, I want to give you the counter argument because I don't just want to give you one side of the argument here, but I want to respond to one of the comments here. Miss Mary says, bartenders can be held liable. Well, but that's also different, right? That's different from somebody walking into a store who's not drunk and buying alcohol. What happens is when you're alcoholized, your ability to make a decision plummets. And if you're wasted inside of a bar, it is incumbent upon society to protect somebody, in my opinion, who's incapable of actually protecting themselves. If somebody's, a 0.2 blasted drunk, they're not capable of protecting themselves. They're not an asset anymore to society. They're a liability, right? And so, yes, regulators have made that incumbent upon those around them. But I don't think that companies who create failures, based on their own business decisions, are at the liberty of begging for the 99% of Americans who pay their taxes and work hard to bail them out. That's just my take. Again, I've got nothing against startups. I have a startup. I'm just more of a capitalist and probably lean more libertarian than suggesting we should basically say FDIC insurance $250. Nah, it's actually unlimited. Yeah, I think that sets very bad standards. It encourages risk by shareholders and executives. And even though they might lose everything, if they could tell their customers, hey, you're basically unlimitedly protected by the government, why not take the risk? You have a greater chance of getting greater shareholder returns. Anyway, in a Financial Times interview, you had sort of another response. This is Ken Griffin, the CEO of Citadel. He says, quote, the U.S. economy is supposed to be a capitalistic system, and that's breaking down before our eyes. We are becoming more socialist every time the government intervenes, or at least a type of crony capitalism. Yeah, like what you're seeing with Gavin Newsom. I mean, think about it. The release that you got was that if FDIC took any kind of loss, then what would happen is other member banks would just have to pay higher FDIC fees. Well, what the hell is that? That's called socialism. Oh, one person lost money? No problem. We'll save them and we'll make everybody pay more because of the failures of, a bank that was too aggressive. That's as Ken Griffin puts it, privatizing gains, but socializing losses. He says there's been a lot of loss of financial discipline with the government bailing out depositors in full. Regulators have created a great moral hazard. There is no incentive for depositors to remotely think about risks or due diligence when trying to stay within the 250K limits. There is also no incentive for banks to risk manage, as the government will always backstop losses. Moral hazard, obviously, is a term used sort of like insurance. People act more reckless when they know the liability is shifted away from them. Counterparty risk is essentially now no longer an issue. There's no such thing as counterparty risk anymore if the government will just bail out everything. Remember, the CFO of Silicon Valley Bank worked at Lehman Brothers. So the people who say, oh, but the executives are going to get fired and lose their jobs and they won't be able to get a job anymore. Dude, the person who worked at Lehman Brothers became the CFO of Silicon Valley Bank. The idea that moral hazard will be limited because executives will get, fired is bullshit. And you could see it in the fact that the guy who worked at Lehman Brothers ended up working as the chief financial officer at Silicon Valley Bank. It's insane. Now, the Fed's launching a probe into exactly what happened with Silicon Valley Bank. This was an interesting one. Even though an individual who left in April was paid $2 million for her work 4 months of 2022 with an average $460,000 severance package. Anyway, basically there were some arguments that massive amounts of money were being spent on salaries and bonuses and severances for people before the collapse. But then you have people like David Sachs, who's a VC guy in Ro Khanna, trying to basically share what they call the full picture. And what they say is that this banking crisis originated in Washington, that it's Washington's fault because they raise rates so rapidly. Dude, how clearly did the Fed telegraph that they were raising rates? To say, oh, well, the banks are just failing because y'all raised rates so rapidly. What do you mean? Literally, for the last 2 years, they've been talking about liftoff and raising rates. And for the last year, they've been doing nothing but saying higher for longer, higher for longer. And Silicon Valley Bank got rid of all of their hedges of increasing interest rates. Come on, David Sachs. Be real. Tell the world about all of the VCs that you were invested in that would have lost a crap load of money and potentially gone bankrupt at Silicon Valley Bank. I don't think there's any way you could say you're not biased in this situation. Now, that doesn't mean you can't have a reasonable argument. Just because you're biased doesn't mean you can't have a reasonable argument. Sometimes I'm biased. Sometimes I have a horse in the race, and maybe I'm biased, right? That's fine. I think everybody has a bias. But I think it's very important to acknowledge that this is not capitalism, David Sachs. This was a bailout by taxpayers of private institutions. As Ken Griffin says, we socialize losses here. Now, there might not end up being any losses. That's possible. And in that case, we wouldn't socialize any losses because the losses would be zero. In fairness, that is possible. It's really just the Fed coming in, turning on the money printer, and holding a bag, which may prove not to be a bag in the future, especially if inflation goes away. Now, you do have people like David Sachs and Ro Khanna also criticizing the weakening of the Dodd-Frank protections for systemically important banks that we had in 2018, but Democrats voted for that as well. It was Donald Trump, a Republican-controlled Congress, and Democrats together who voted for this. The only people who didn't vote for this deregulation in 2018, the banking deregulation bill, were basically progressive Democrats. That's it. So you had a super majority of people who voted for this deregulation. So yes, I think deregulation has something to do with this. But that, just because, two rights don't make a wrong. Just because you made the mistake of deregulating doesn't mean, now all of a sudden we should bail everything out to 100%. A little bit of a haircut is healthy. David Sachs obviously echoes what Bill Ackman say that, well, the run on the banks would have been a lot worse had we not come out to bail these individuals out. Maybe. That's entirely possible. That, the banking runs would have been a lot worse, although I think the banking runs are still to some degree just beginning. And that's another possible danger, is that the banking runs could actually continue to get worse. I think what you've really done is I really think that venture capital people and startups are smart people. I think there are a lot of smart people. And I think the smart people who just had their ass saved at Silicon Valley Bank or Signature or some of these other banks are going, well, I'm not going to make that mistake again. I'm going to diversify my banks. I think that's very reasonable, and I think that's going to happen. So I think the banking run is going to continue, albeit at a slower, less panicked pace. But I think that the true damage of that is still yet to be seen. And that's why all eyes are on the Fed for what they're going to do with hiking rates. Anyway, Silicon Valley Bank was known for providing what was known as a white glove, red carpet treatment of Silicon Valley executives, including providing not only basically credit lines to cashless companies or companies without any cash flow with little questions asked other than the fact that you were a startup, but they also provided white glove services for some of these folks, including mortgages for founders of startups, basically giving them whatever financing and terms they want, just to promise to be a member of the bank. See, that's not risk management, folks. That's nonsense. Anyway, regulators are attempting another auction of Silicon Valley Bank after failing to find a buyer of the weekend. Banks and private equity funds are circling, and startups are scrambling to find a new home for their cash. During the chaos, companies with accounts elsewhere transferred their funds while others struggled with red tape and frantically opened new accounts. Fintechs like Brex apparently experienced a surge in activities, with the company opening over 3,000 new accounts. Wow. Big banks, obviously, like B of A, Citi, JP Morgan, is seeing massive inflows. These are called the gray carpet treatment banks instead of a red carpet treatment bank. And this is true. They have less customized services, right? It's one of the reasons I've taken some of my money and had it at some of the smaller banks, because you do have better funding and easier credit lines. You know, I was able to get a rental property home equity line of credit, RELOC, and a 90% home equity line of credit from a small credit union. I could have never in my dreams gotten that from a big four bank. But I kept my exposure to those accounts to less than $250K or $500K as a married individual, right? So, like, you could play the game. You could use the riskier lending, but at least include some risk mitigation procedures. So, worth noting, obviously, all of this comes on the heels of Greg Becker selling $3.6 million worth of shares. The SEC is now investigating this. But on top of that, you have TS Lombard, which has a really interesting piece about how really this banking crisis could really just be the beginning of really a greater recessionary disaster. And I think this piece is really interesting to look at, how the asset cycle ends. But before we talk about how the asset cycle ends, I have to thank you for being here. Really appreciate the fact that you're here. It's nice of you to watch my videos. My goal, I just want you to know this is sincerely, I want you to know that I'm a place you get unique perspective and value that you find, I'm not going to say you can't find anywhere else, but maybe you find difficult to find somewhere else. And if I can consolidate information and give you better value faster than anywhere else and more efficiently, then I'm very, very happy about that, because my goal is, you know, over the next 20, 30 years, I could keep making YouTube videos and providing this kind of value. So thank you for being here. We couldn't do it without y'all. So it's a win-win, I think. All right. So what does TS Lombard say us? So basically, they have this article here. They have this piece, and they're bearish, right? They're bears. So they have this piece where they talk about bank assets will consequently migrate back to where yield is highest and liquidity is frictionless. So in other words, that right now, what you're experiencing is there are two types of cycles. There's a credit cycle and there's an asset cycle. See, they say that. Ever since the GFC ended, the U.S. economy has been driven by an asset cycle rather than a credit cycle. In other words, this is money printing. This here is borrowing. And so you have shifted vulnerabilities from liabilities to assets. When you have a debt cycle, you have too much debt. You have a liability crisis. When you have an asset cycle, you have too much cash. So what do you do with that cash? You park it into assets. But if those assets, like treasury bills, lose values or lose their value, then you get screwed, right? So the shift creates some unique distortions, should I say? The biggest distortion you have is you have this massive flow of capital to tech companies. However, now we're finally starting to see a little bit of a U-turn in tech. And TS Lombard says that U-turn in tech is basically and potentially the beginning of the real recession that we're walking into. They say here, look at this section, this paragraph right here. Money, like water, flows in the direction of least resistance. This was true for the housing industry pre-2008 and for tech in the current cycle. Like housing, tech was distorted by a seemingly unlimited flow of cheap capital and credit. Just when limitlessly cheap turned into limited and expensive, that is, money, as it always happens, tech revenues began to weaken. So in other words, at the same time as interest rates started going up and we turned the money printer off, tech revenues started going down. Now, there could be a causation and correlation argument here, but anyway. The outsized tech expansion in the past few years and its current crunch is particularly evident in employment. After leading the economy in hiring, tech leads the reduction in headcount. Looking back to December of 2019, as a base of comparison, tech employment is up 15% versus 4% for the employment of the area excluding tech, retail, and health services, and leisure and hospitality. In other words, employment at tech up 15%. Everything else only up 4%. However, tech is now down while you're still seeing increases in retail. So, what else does TS Lombard say us about this? Well, what do they say? They tell us that asset/liability matches have gone awry because deposit outflows have broken the traditional model that we're used to with and this is reminiscent of what happened with collateralized debt obligations back in 2008. Mortgage defaults skyrocketed through lower tranche firewalls that were suggested, or that models suggested could not happen. In other words, we relied on these fancy models in 2008 that suggested things can't be that bad. Yet what are we dealing with today? Well, we're dealing with these models that suggest, oh, don't worry, we can spend through the recession. The recession won't actually be that bad. Well, that really remains to be seen. And T.S. Lombard really thinks that a recession is ahead of us. They say, in sum, a recession is inevitable. Silicon Valley Bank and the knock-on impact on bank credit activity brings forward the timing. And keep an eye on tech. The flow of economic data in the coming few days, CPI today, which we already had, that was yesterday, because this report was from yesterday, will have, or actually CPI was now 2 days ago. Anyway, we'll have the FOMC hiking by 25 BP next week. The Fed also hiked through bank failures before, and will through this one. That's a very interesting argument. They're saying, look, tech, which was the big driver, weakening. The asset bubble is turning. Everything's slowing down. This recession is going to hit hard. But not only is this recession going to hit hard, you better believe the Fed is going to go for 25 BP here. The Fed's done it before, and they'll do it again. Precisely because it will not be seen as systemic to the banking system. In other words, the Credit Suisse drama, Silicon Valley Bank will not be seen as systemic. While this is true relative to 2008, Silicon Valley Bank is also a warning that there may be more damage to come in the financial system. This is not mortgages creating a great financial crisis, but it nevertheless leads to a recession outcome. So, in other words, the slowdown of the asset cycle, the banking crisis, the tech slowdown, T.S. Lombard's opinion, big recession coming. That's what gets rid of inflation. Now, all of that comes on the backs of these comments of us bailing out banks. Is there a potential Goldilocks solution here? Maybe. Counter argument is, bail out these idiosyncratic issues, these individual bank issues, bail them out, let inflation fall with inflation or with the rates that we have now, maybe another 25 BP, or we stay stable. Let inflation fall. As inflation falls, maybe we can keep going without more banking crises and more banking failures. In which case, if we end up killing inflation, here's the Goldilocks scenario. We kill inflation, owner's equivalent rents come down, sticky services come down, we kill inflation. We have no recession or a very shallow recession. Businesses and consumers spend through the recession. Yes, you have a little bit of hit on staples and discretionaries expected, but it's minor. And then what do? You come out on the other side with companies that are much more lean and efficient now and able to create more profits. In other words, and taxpayers don't end up fronting any losses to the banking sector. So in other words, as this bubble is deflating, the conditions are present to where we could actually just reinflate the bubble and go back to the moon, which is kind of scary and crazy. You'd think we'd have to go through some more pain, but the government right now is doing a really good job of making sure that nobody can fail. No failures. Socialism. No failures. Nobody's allowed to fail. But hey, as somebody who's invested in stocks, maybe I'm biased to the upside, and hopefully that's what happens. But I think T.S. Lombard makes a good point that we have yet to see how this asset tightening cycle, which is being evidenced by the bank failures, will end up affecting earnings. I think it's funny that somebody here in the comments says employees and investors didn't get bailed out by the banks. Yes, they did. First of all, employees got bailed out, and maybe investors didn't, but employees did. They all got a 50% pay bump paid for by the FDIC to stay with the bank for another 45 days. Yes, they're going to have to find another job, but let's be real. They got bailed out too. So the idea that, well, not everybody got bailed out somehow makes this time different is nonsense. It's a bailout. Let's be real about that. It is a bailout. Suggesting it's not a bailout, in my opinion, is just, it's a Looney Tune. It's an absolute Looney Tune. It's a bailout. It's very simple. The taxpayer will foot the bill. If there's any loss, the taxpayer pays for it. In fact, the taxpayer already paid for those salaries, for example, because of the appropriations that set up this facility in the first place. Congress took taxpayer money and stuck it into a fund that we're now using to bail everyone out. Yeah, somebody here says it's bailout light. Yeah, it's a diet bailout. There you go.